Hello, in traders. Doing trouble there from DRFX, swing trading mentoring. Going to be taking a look at a recent trade that was just completed on the Canadian Japanese yen, where we captured a quick trading gain of 50 pips from this currency pair, as we took advantage of the bear crown head and shoulders pattern that was formed on the 4-hour chart that indicated the start of a downtrend in favor of the Japanese yen. Now, market direction is determined by using the Japanese candlestick signals, trend lines, and consolidation setups provided by the daily chart on the 4-hour chart. And once a trading opportunity has been identified, entry then takes place using the signals and patterns provided by the 4-hour chart, with the signals and patterns of this time frame also used to protect the trade with our stop losses that ensures that we're able to stay in the trade until our trading target has been hit. FXCM is used to identify market direction and entry signals. However, when it comes to my live trades, I actually prefer to use FX Pro for two main reasons. The first is that when you're actually executing a trade, you can actually see the exact risk and reward values in percentage terms for each trade, which ensure that you're able to stay within your risk parameters and that you're able to capture the minimum return that you have established for your trading. And the second reason is that you can actually receive email alerts so that after you have executed the trade, you don't actually have to monitor the trade until the trading target has been hit. Now, there are actually three main setups that are trading as part of my methodology. The first is that I identify the early set of bearish and bullish waves that indicate that the market is going to be forming consolidation. So instead of waiting until the consolidation has been finally completed with clearly formed boundaries of resistance and support, what we do is identify the early waves that indicate that the market is going to be forming consolidation and trade these waves until the consolidation has been completed. Of course, once the consolidation has been completed, we will continue to trade in this sideways pattern, which can take the form of either a range consolidation setup or a pennant consolidation, where the market can form three types of pennants with different angles of resistance and support boundaries. The third setup is that we trade false consolidation breakout reversals, where the market will attempt a breakout at one end of the consolidation and then reverse sharply to take us back inside of the consolidation. So these are the three main types of setups that are traded as part of my methodology. I no longer trade major breakouts from consolidation on the daily chart and the 4-hour chart, mainly because these types of breakouts are not as common as they were before, and even when they do take place, there's a lot of volatility and uncertainty when it comes to these types of breakouts. What I found instead is that if we focus on these types of setups that take place within the formation or as part of the movement within consolidation, these signals tend to be a lot more frequent. These setups tend to be a lot more frequent, and the signals and patterns provided by these setups tend to be a lot more reliable compared to the ones associated with consolidation breakouts. Now, once a trading opportunity has been identified within the context of these three setups, the main objective is to capture a trading gain of between 50 pips and 70 pips within 24 hours using those signals and patterns provided by the daily chart and the 4-hour chart. In some cases where justified, we would also capture trading gains of between 30 pips and 50 pips within 24 hours. And in even rare occasions, we'd also attempt to capture trading gains of between 70 pips and 100 pips and extend the holding period from 24 hours to 48 hours in order to be able to capture those larger pip movements. Now, the trade that was done on the Canadian Japanese yen represented an example of trading the early set of waves that lead to the formation of consolidation. Now, here you can see the setup on the 4-hour chart of this currency pair, where you can see that the market had actually formed this first bullish wave, this first uptrend, and was now transitioning to start a bearish wave as part of the formation of a projected consolidation setup. So what was taking place was a break of this uptrend line and the start of a downtrend that was actually taking the form of a bear crown, otherwise known as a head and shoulders pattern. Here we can see this setup in more detail, where when it comes to the formation of a bear crown, typically what we see is that the market forms a left tip, which would be this area here, one of the last formations as part of the previous trend. It will then continue to attempt to move in the existing trend direction before U-turning one last time to break trend lines that would have been formed along the way and start the trend direction in a new direction. In the new trend direction, as part of the formation of this new downtrend, it will form a right tip, which in this case took the form of a bearish engulfing candlestick formation or a counter trend line breakout, which represented the indication of the start of a downtrend and was also represents the first setup as part of this new downtrend. Now, from the trading manual, the basic theory is basically explained to show you how this transition takes place, which is one of the most common transitional patterns that you will see when it comes to trend changes using Japanese candlestick formations. So as I said before, essentially what takes place is that with the previous trend that is ending, it will form one last setup and then attempt to move in the direction of the existing trend one last time before failing and then U-turn to break trend lines that would have been formed along the way. Now, in most cases, it will form a setup which represents the first setup as part of the new trend direction, which is known as the right tip. And then once that setup is broken with a bearish candlestick formation, which is the case that you see here, it will indicate the start of the movement bearish and provide us with trading opportunities to take advantage of this new trend direction. So to take advantage of this setup, what was done was to enter the market at the close of this bear crown of this bearish candlestick formation with a stop loss placed at 84.83, just above the downtrend line here that you can see here represented as this red line. Once entry took place, the trading target was set at 50 pips, which was deemed to be a very comfortable area to aim for. Basically under the assumption that the market may not actually go all the way down to the support point, because what can happen is that it can actually form this second wave, start the second bullish wave a little higher up without actually hitting the support point. So that is why, as you can see here, what I do sometimes is to assume that the market is going to be forming an angled support boundary because of the possibility that it may not actually go down all the way to the support boundary. So the 50 pips was set at an area that would allow us to capture a trading gain quite comfortably before the market possibly starts its U-turn just above the support point. And as you can see here, this was a setup on my live account. As I said before, FXCM is used for my market analysis, but my live trades actually take place with FX Pro. So you can see the setup here on FX Pro where the stop loss was placed above the downtrend line. Entry taking place at the close of this bear crown of this, well, the right tip of this bear crown setup at this bearish candlestick formation. And the take profit set at 50 pips. That was expected to be hit just above the support level. So the main aspects of this trade setup were that the market was starting a trend change on a 4-hour chart as part of the formation of a consolidation on this time frame. This was taking the form of a bear crown setup, otherwise known as a head and shoulders pattern. And entry was going to be taking place at the break of that counter trend line setup, with the stop loss placed above the downtrend line of the 4-hour chart to protect the trade. Now the expectation was that the market was going to be headed towards the support point, but it could either hit the support point or it could start to U-turn and transition towards an uptrend before actually hitting the support point. So the trading target of 50 pips was set to take into consideration the possibility of a U-turn taking place before actually hitting support. One of the main guidelines of this trade was that we should not monitor the trade, because monitoring the trade can lead to the bad habit of closing our trades too early, and over the long term this can lead to a self-sabotaging habit of basically not being able to maximize on the profitability provided by the market from one trade to another. So to avoid that, the best thing to do is to not monitor the trade and only look at the trade once the trade has been completed. And with these types of trading targets of between 50 pips and 70 pips, in most cases, they tend to hit these types of trading targets. The market tends to hit these types of trading targets within 24 hours. So there's really no need in most cases to actually extend and hold the trade for more than this period. And as you can see here, the market responded to the bear crown setup and this bear signal by moving lower and actually hitting our trading target and allowing us to capture the trading gain of 50 pips. You can see here this trade result on the left hand side by the FX Pro email alert that was sent to me, indicating that the take profit order had been filled. And you can see here on the right hand side the basic summary of this trade, which captured a trading gain of 50 pips in just over 13 hours and represented a rate of return of 4.98% on my live account. Depending on the level of risk that you would have taken for this trade, this rate of return could have been anywhere between 2% and 5% on your trading account. But for me, I generally tend to risk between 3% and 4%, sometimes higher. And this usually provides me with a rate of return of between 4% and 5% per trade. So in summary, the market declined as expected in response to the bear crown setup and the bearish candlestick formation. Target of 50 pips was captured well within the 24-hour holding period. And in this case, the decline was fairly sharp and quick with very little pullbacks. In fact, there were actually no pullbacks that actually took place as the market hit our trading target and responded quickly to the bear crown setup. And overall, this was a typical example of the benefits of being able to accurately forecast and accurately analyze what is taking place on the daily chart, on the 4-hour chart. And because of the greater reliability of the signals provided by these larger time frames, most of your analysis will be accurate, and you'll be able to capture strong trading gains as part of these, to take advantage of these accurate forecasts. So this was a setup and this was a trade result, taking advantage of the formation of a consolidation setup on a 4-hour chart, which in this case was taking the form of a transition from an uptrend to a downtrend. That was taking the form of a bear crown head and shoulders pattern, which is a very common pattern, a very popular pattern when it comes to the start of trend changes across the currency market. So until next time, traders, happy trading.